Hello there, we're live, and it's going to be a quick one today because I'm going to give you guys a break. I have to get out of here and get somewhere and get ready for a big night out. I'll tell you about that in a moment. But real quick, I had a really good day today, and I had a special day because I was on my friend Rhonda's radio show. I have to sneeze. Hold on. That's the vagaries of going live, right? It's not TV, it's just live streaming, right? So, excuse me. Hell of a time to need a drink of water really badly right now. So it's on my friend Rhonda's radio show, Long Island News, 103.9 FM. And it's called the Credit Authority. And she had me on as a guest. She also had another financial advisor there. He's not really a financial advisor. He's a hedge fund manager. And we're talking about the market and, and we're talking about the market. And Rhonda's asking a lot of really good questions, basically asking us the same questions. He went first, then I went. And I was really not at all surprised that our answers were different. And it really speaks to the difference between a hedge fund investor, an institutional investor, and a retail investor, which is me, which is you, and it's just a different mindset. Elon Musk, should investors be totally freaking pissed at this guy because now he's spending all his time on Twitter, managing Twitter that he bought while, Tesla stock keeps sliding? And what about oil? Oil comes down hard, and it's a pretty quiet day in the markets. And I said this a few days ago, or on Monday, it's already Thursday, that, it's before Thanksgiving. Nobody really wants to do anything. There's a tired feel. People, I think, just want to get the hell out of here after a crazy couple of months in the stock market. And that's what they're working on, right? So I'm just looking over here, my audio's down here, making sure that my lines are staying within the same zone. I'm using a new audio mixer, and it takes a little getting used to, but I'm loving it so far. It's the Rodecaster Pro 2. All right, so let's roll a quick introduction, pop the banner up, get the intro going, and then I'm just going to go through a couple of things, and I'll let you go. So here we go. All right, so thank you for joining me. I'm Mitch Goldberg. You're watching my live stream, Be the Boss of Your Money, which is about investing, the stock market, the economy, personal finance, but ultimately it's educational so that you could help yourself make the best possible financial decisions. And one of the things that I was talking to Rhonda today on her radio show, and with this fund manager, his name is Jeff, and a real nice guy, just we are in different parts of the business. And, my thing is, my favorite expression, especially in calamitous markets, is don't just do something, stand there. The expression, don't just stand there, do something. I reverse it. Don't just do something, stand there. Because to me, tinkering with your portfolio too much is a mistake. It's the more you tinker, the lower your returns are. And the less you tinker, the better your temperament is to ignore bad news, ignore the market, ignore your investments, and just plow forward, the better off you are. So we have to educate ourselves to not just know that, but if you understand how the economy affects you, how the stock market affects you, what you're investing for, your goals, how you're investing, what you're investing into, if you understand all this, and if you learn about this, and you learn about your personal finance, it makes it much easier to avoid impulsive or fear-based actions or greed-based actions. And what I mean by that is, we spend a lot of time with our clients here educating them about why they should be invested in a certain way based on their risk tolerance, which most people have no clue what their risk tolerance is. Even people who say, oh, I'm a risk taker, quite often they're really not a risk taker. They just don't know what they mean. And sometimes people say, I'm a moderate investor, but then they want higher returns so the market goes up a lot, which makes no sense. You're a moderate investor, so you should shoot for moderate returns, not big returns. And then some people jump on the hot thing of the day. It could be crypto, it could be, pot stocks, whatever the hot thing is. And I just teach people how to ignore these things. And that is part of the education process. Listen, I educate for myself too. I'm always looking to become more educated. I'm a lifelong learner, and it helps me avoid making wrong decisions. What I mean by that is impulsive decisions. You'll find that in the stock market, in investing, it's you'll find that in investing, time almost always bails you out. Now, there's two different kinds of investors. There's the diversified investor, someone who's using exchange traded funds or has different stocks from different sectors and different bonds. Okay. That person recovers from bear markets. Okay. Now, diversification is a strategy that we use to mitigate risk, but it doesn't mean that your portfolio that it doesn't necessarily mean your portfolio won't go down in a generally down market, but you're expected to recover. Now, if you're somebody who's a concentrated investor in individual stocks or other things to invest in, you bought crypto at 60,000, you bought Roku at 700, for example, and you bought other pandemic type stocks when they were way up. Well, we could look at Teladoc and so many others. There's a good chance time doesn't bail you out. Now, I'm not picking on those particular stocks. I'm not picking on you if you're in those stocks, but you have to look at the circumstances, the situation that led to the rise of these stocks. Now, I look at a Procter and Gamble or a Honeywell, and they just keep plowing ahead. They reinvest in research and development. They're always looking to cut expenses, do things cheaper, more profitably. They become important in the global economy. We can't live without their products. That is a completely different kind of company than another streaming company or another, TV streaming service, of which there are so many. So what this fund manager was saying is, I like to, be proactive. The best way to be defensive is, as an investor, you should be proactive. And he says he teaches investors to be proactive. I teach investors to be, I'm not saying we're not proactive, but I teach investors to leave things alone. I teach investors control the things you could control. Now, I don't know what that means. I didn't have a chance to get into it. What do you mean by teaching investors to be proactive? Like, does that mean sell when the market goes down? Does that mean buy options when you think the market's going to pop? I believe time is more important than timing the market. Time in the market is more important than timing the market. And I believe that if you want to lower your risk, extend your time horizon. But your time horizon, meaning to the time when you have to start using your stock money to pay for your financial obligations, that is what determines how much risk you could take. And so what I want to do is control the things we could control. Okay, you could control how much you have in stocks, cash, and bonds. That's a general asset allocation model. You could control if you keep investing into your 401k plan thick and thin, through and through during a bear market. You could control if you want to invest in dividend paying stocks or not dividend paying stocks. You could control the tax buckets, like you put more money into into a retirement plan. Do you put more money into a regular taxable brokerage account? Do you do a backdoor Roth IRA? These are the things you could control. Did you update your will? Do you have adequate insurance coverage for health insurance, life insurance, disability, long-term care, etc.? And you might not be able to do everything perfectly, but what is the balance that works for you? Control the things you could control, and let the process take care of itself. Trust the process, surrender the results. Ultimately, the market finds a way to go higher. And you could tinker with your portfolio all you want, but by and large, over 30 years as a financial advisor, I don't know too many tinkerers who have become very successful investors. So that's my story. I'm sticking to it. Let's take a look at the stock of the day. Okay. First one that we're going to look at is Tesla. Now, this stock was like 205, 202 at a low, and it went to 230. And people think, oh, this is easy money because a friend of mine said she liked the stock at 202 and she bought it and sent me a text like how good it's doing. And I'm like, whatever. Don't pump yourself up on such a short-term move. And now it's 183. And so it's down about 10% from this person's buy point. And that happens. I'm not picking on this person. I'm just saying, did you buy it because you thought it would be a stock that would go up quickly? Or did you buy it because you think that long-term Tesla stock is going to be a good buy and reflect the value of this incredible business? Or do you think the business might not be so incredible? But anyway, the CEO, the leader of Tesla is Elon Musk. And now he's distracted with managing Twitter. And if I was a shareholder losing money on Tesla, I would be annoyed, very annoyed that this guy is, he's spending his time uh, on Twitter. Well, I'm losing money in Tesla. So that's why Tesla is the stock of the day. Listen, the stock of the day doesn't necessarily have to be a happy story. And I like to give two stocks of the day. The next one is Merck. Now, Merck is a drug company, staid, boring, old line drug company. The stock was in the 60s and 70s and 80s forever, but it keeps moving up. And now it's over 100. And it's just like little by little. And that's the kind of gain I like. I like to see a stock make little gains persistently over time than one big gain in one day because of a good earnings report. And then the stock comes right back down a week later. And Merck seems to me to have become an anointed stock. An anointed stock means investors are looking to put their money into best of breed stocks. So what's the best drug company? What's the best bank? And a lot of investors will say the best or one of the top drug companies is Merck. And that's a stock that becomes anointed a must-own stock by investors. And it appears Merck is doing that because it keeps going up. I'm not, I can say that. This is not a recommendation. I'm making the observation. And if you want to check out the chart, let's look at the year-to-date chart. It's persistently higher. Persistent, consistent. The stock is a bull, and it still pays almost a 2.7% dividend yield. It's up 33% on the year. And this is the type of stock where a retail investor, aka small investor, could say, oh, it's up too much already. I missed it. It's also the kind of stock that an institutional investor will say, this is what's working because it's good. That's what I want. That's what I'm going to buy. And that is more important. And that's what keeps a stock like Merck on the up and up. Okay. Got a couple of YouTube comments, which I will definitely not be sharing because people are gross and these are strangers. And that's what you get when you are a, public broadcaster. Okay. In the meantime, Dow only down 7 points, no big deal. Nasdaq down, 1/3%. S&P off less than 1/3%. Very small moves today. The only really notable move today is oil. Oil was down 4%, over $3 a barrel. And why is that? A lot of people feel inflation has peaked. Oil was starting to go up over the last couple of weeks. You can see the price of gasoline going up. But that's because people are thinking China is going to open up its economy, stop with the COVID zero policy, and demand for oil would skyrocket because demand for gasoline would go up. And maybe it'll happen, but it looks like that trade has already come and gone. And it's interesting to note that the United States is actually pumping more oil now than it ever has in history. And there is enough oil to go around. We do have a war, and it's disruptive, but the rest of the world is adjusting to it, and we'll see how it goes. I am not super bulled up on oil at the moment. And if things do calm down with this war, which is not really factored in, you could see oil drop down to maybe 50 or 60 a barrel. All right. Let's take a look at interest rates. Yields have been going down. They're up across the board, not to where they were a week ago, but nonetheless, yields are up a little bit. The 3-month at 4.23. By the way, if the 3-month T bill is at 4.23 where it is now, or 4.27 or 4.3, for me, that doesn't make a difference. I'm not going to say, damn it, I'm going to hold off on buying 3-month T bills because I could have gotten 0.5% higher a week ago. If you're so sensitive to that, to a tenth or a 0.5% and a yield over 4%, it's not even a 0.5%. We're talking like a tenth or 0.2% difference. Your thinking is off. You can't time the stuff. Don't bother. And that's not what's going to make or break you. You're putting your money into a safe place that earns a return that you haven't seen in years. That's really what counts. Let's take a look at crypto. Okay, so crypto has actually had a pretty good day today. And why do I look at cryptos again? It's for a reason, because we used to look at crypto every day. Used to talk about it a lot here. Then I stopped talking about it for months. Just was a loss of investor interest, but it's exploded now back into the news because of FTX, a crypto exchange that collapsed, and the CEO is using the money, customers' money, to buy houses for employees, to buy goodies for himself, to prop up his own trading firm. And it's really like horrendous that you put your money into an account and the people that manage the firm that holds the account just take the money and use it for themselves. It's just like everything that could possibly go wrong in terms of screwing over your clients is what happened with this. So it's going to be very interesting to see how that unwinds. It'll be interesting to see how it spreads to other crypto firms that could go out of business. And it'll be interesting to see if more people are forced to liquidate Bitcoin. But quite frankly, crypto touched the high 15,000s, but it's been steady for the last week or so, at least, while the news out of FTX has been getting worse. And the concern a week ago, was that the disaster in the crypto space would spill over into other areas of the market. But so far, it looks to be pretty much contained. It's not contagion from crypto. So those are the important things to watch. We're keeping an eye on these things. Anyway, I typically don't stream on Fridays, so I want to wish everybody a great weekend, unless something crazy happens tomorrow. And I'm going to be, I know, I just want to say I'm going to be an honoree tonight. There's 17 people tonight, financial and business professionals, who are receiving an award tonight. I am fortunate to be one of them. I'm going to have a lot of friends there, and I'm so looking forward to getting out tonight and being with everybody. So that's why I have to get going now, and I have to shave, put on a nice suit and tie. I'll post pictures on social media tomorrow. Take a look, and I'll speak to you soon. If you have any questions about what we talked about today, please ask in the comments. And if you enjoyed this, please give it a thumbs up, a heart, or some other reaction, and let your network know that you checked us out today and you enjoyed it. Okay? Thanks so much. Talk to you soon.